Hello and welcome. You're watching The Investing Edge. I'm Sumaira Abdi. Well, wealth management has been evolving as a science. So what are the lessons that this industry has learned from the pandemic? How has the role of an advisor changed? And more importantly, how do you as an investor benefit, or what are the mistakes that you have made and how can you learn from it as we move forward? Joining me as always is Feroze Azeez, Deputy CEO of AnandRathi Private Wealth Management. Hi Feroze, thanks very much for joining in. And one of the first things I want to talk about is basically, through this year, a lot of investors have been grappling with how to deal with their finances and the pandemic. So, when we saw the fall actually begin in March, what was the way that investors should have dealt with it? What was the advice that you gave your clients?
Smira, I think advisor, like you rightly pointed out, learns from each of these episodes. And advisor's role gets amplified during these tail events, as we call them. So point one, I think we at AnandRathi definitely tried our best to take care of three things. One is to emotionally handhold the client. I think that's the softer aspect of the relationship. Your engagement levels during these periods with your HNI community or future HNI have to be very high. So you can't have the same frequency of interaction, point one. Point two, provide tangible solutions to protect money. Like, for example, during these situations, we bought ourselves or recommended our clients before the March 23rd, maybe the week before that, to buy themselves put options to protect their downsides if they so chose to, especially the ones with a weaker heart. And the last one is, if things like these happen, there are opportunities as well. But they don't seem like opportunities back then. So volatilities were at the historical highest ever, maybe 60% more than in 2008. So we designed best structure products, which are very easy to design in higher volatile environments, and then collected as much money in those fruitful products, which have made 15-20% in the last 3-4 months. So all the three things, the emotional aspect, the tangible protection, and the opportunity capitalization, all three of them have to be done in an optimal mix during exaggerated periods of fall.
So, Feroze, then, if you've sort of made fresh arrangements or new strategies to deal with a new situation, which is in our case the pandemic right now, how long does that strategy last? Or, is it an active call that you would take, like, say, if the vaccine was discovered, or if there is growth momentum that returns to the economy? What would be the forward triggers that a strategy like this would hinge upon?
See, I think this should ideally not be called a strategy at all. It's a tactical allocation you do to ride through short spans of time, maybe 6 months or a year. So let me distinguish that as a tactical move, either to protect, either to capitalize on the opportunity. And now that there's a tactical move, how long does it last? To my mind, if you look at this example, where the markets have rebounded to each of our surprises sooner than expected, then it might just last 3-4 months. So to take you back to the example I gave, we made 1-year structure products which would protect the money and still participate reasonably with an expected return of 20-25% a year. So 4 months into the game, most of the return is already made. So you may want to pre-close that and move on. So to answer your question, it's a tactical allocation, and the period of its existence in the overall scheme of things will depend on how things pan out after that episode of adversity.
So, Feroze, if this is tactical and not the core portfolio, how much of a client's portfolio, or in what proportion would you allocate to this tactical play?
So if I give you the actual example, we allocated 10% of one's money into the opportunity, maybe 3-4-5% to protect downsides in case things go down south further. So these are the two in terms of proportions. To protect, you don't spend more than 2-3-4% at best, and to capitalize on opportunity, about 10%.
Okay, now let's talk about the closest comparison, right, that this pandemic is. And to most minds, that would be the global financial crisis, right? There are a lot of people who have said that this is a repeat. And there are as many people who say that, you know what, it's not. We've learned lessons from there and we're better equipped to handle it. Which camp are you in? And how different or similar do you think this is to the GFC?
No, they're very, very different to my mind. Outcomes could look similar after a year and a half. Firstly, if you look at it statistically, pandemic fall in the month of March is just a 1.5 sigma event, by which I mean a 6 sigma event like people call it to be. Statistically, from a capital market standpoint, it is a 2 sigma event at best. But a global financial crisis was a 4 sigma event. So that was a far more powerful correction. Second is, in our opinion, the tools discovered in the global financial crisis are at work in this next crisis. So liquidity, which was being used to sail through that period, has been readily available in the beginning of the fall, unlike in the global financial crisis. So we learned from there that an interim money supply, which today most central banks are doing, especially the Western world, has done that more effectively than the Indian context. But India also created immense money supply and have forgotten the rules momentarily of how much money supply should be there in the system. So to answer your question, both are different statistically in terms of the size of the impact, point one. Point two, the solution discovered in the global financial crisis, maybe in the latter part of it, has been used from day one, or almost prepared to be used from day one of this pandemic. So that's helped the current situation from an investor standpoint.
Okay, so clearly governments, central banks, those in liquidity management, risk management have learned their lessons. But how has an advisor evolved? What would be the learnings for a financial advisor from, in the last 10 years till now? And how do you think their role would have changed?
I think one advisor learning, which we had in 2013, fortunately, is that an advisor cannot be a product seller. There's a thin line between an advisor and a product seller. If you keep giving products after products without the context, then during times like these, you would be grappling with each of these components which you've put into people's portfolios or client investors' portfolios. Point one, transition from a product seller to an advisor should be faster, which I think the wealth management industry should take home, point one. Point two, an advisor should know how many clients can he actually manage. Because during bad times, the need of engagement is so high that if you have 100 clients per private banker or a relationship manager in the banking system or in the private wealth system, 100 people you will not be able to engage during these tough times. So there has to be a limit set in terms of how many people can one advise. That has actually been very diverse in the industry. There could be banking system where you have 150 clients per relationship manager. There could be boutique houses where there are only 20 clients per relationship manager or a private. So having some degree of parity and having some cap to the number of relationships you can manage so that you can handhold them when they need you the most is the second piece of learning from a business strategy perspective.
That's true. Actually, too much of a good thing is not such a good thing after all, right? Okay, we'll take a very quick break, come back in a bit. On the other side, we'll talk about just some of these products that Feroze mentioned, why you shouldn't focus on too many or spread yourself too thin. All of that is lined up next. Stay tuned. Welcome back. You're watching The Investing Edge, and with me, as always, is Feroze Azeez, Deputy CEO of AnandRathi Private Wealth Management. Feroze, before we took a break, you were telling us about how, as an advisor, you shouldn't spread yourself too thin, have too many products, and try to sell or market all of them, right? So how have you narrowed down, the two products that you use? And the universe is what, 8, 9, roughly? How do you narrow it down to just two?
Yeah, so everybody has their own filter criteria, but filter in the first place is the most important thing. Quite a few wealth management outfits may choose to offer everything, But we at AnandRathi very strongly believe that we have to take the doctor's role, not the pharmacist who has everything on the shelf for an investor to pick up. So every wealth management outfit has different criteria. What's our criteria to boil down to two? We look at return, risk-adjusted return in turn, liquidity, lesser fine print, more regulation, and transparency. These are few. Then if you go to the second leg of filters, cost, tax, all these filters have to be very seriously looked at when you're trying to percolate all the products to come to what you will actually end up offering to the investor fraternity. So we are very strict there. And that's why a large 8, 9 popular ones, but if you count all of them, it's about 22 of them. We could just get 2 of them in the current platform construct of each of these products. So if you don't have these tight filters, a wealth management outfit might end up offering everything. And that's not a good idea, to my mind, in the advisory business. If you're in the distribution business, then it's great. So you distribute everything which is available.
Okay, so basically high conviction ideas. But Feroze, one of them that you have chosen amongst these 2 is structured products, right? Now, there's a lot of criticism for structured products is that, it does come with its own associated credit risks. So how do you handle that?
Yes, people definitely get worried sometimes with structured products, credit risk. But what we should ideally do is credit risk has to be managed. That's why at AnandRathi, we look at only AnandRathi structured products. Okay, it might seem like a bias, but if it's my own NBFC as a group, then there is clear understanding of what this money is supposed to be deployed for, what are the risk management techniques, how do you course correct. If you distribute it across 10 different structured product issuers, then 1 or 2 of them might fail. Because you have too many of them. So what we do is we recommend only an AnandRathi structured product and don't go by ratings. And in the AnandRathi structured product, we make sure whatever money is there is very prudently invested rather than lent out. So if you have a large component of your money which is coming in the form of structured product in the NBFC, in GSECs, then the it's not of default because you have sovereign almost 30% of your money. You have bank fixed deposits to furnish as margin. So to answer your pointed question, credit risk is very critical in a structured product, but it has to be managed with a microscopic lens. Only if you're able to do that, then you should be offering this product to your investor. At AnandRathi, we've been offering structured products from 2012 December, and we've been very, very cautious on our NBFC side. That's why you have negligible NPAs, because most of the money is not lent but invested in the current situation.
Okay, that's a fair point. But, Feroze, I'm curious that, living in a country like India, having investors who are fascinated with gold and real estate. I mean, forget real estate for once because we've spoken about it enough. I'm curious to know how you never, advised or recommended investing in gold, and how come none of the investors ever resisted it?
Yes, so one is the filters which we just spoke of, Sumera, like what happens is investor thought process is different. An advisor has to be very mathematical about it. The 3-year rolling return of gold is about 12% till 2019 from 2000. 12% is the rolling return on a 3-year basis per annum for this century. Then if you look at the standard deviation or the risk it took is not as low as people think. So point is, it has a risk measure of 9. It has a 3-year rolling return of 12. The perception of gold is that it's a very low risk instrument. But debt has a 2 standard deviation, gold has a 9 standard deviation, which implies it is 4 times more price risk than debt. So that's point 1. Point 2, after this huge rally, and thankfully this rally has come on the back of the pandemic's uncertainty, in spite of that, the rolling returns are just about 11-12%. Point 1 I'm making is, gold is not a bad asset class. It already is there in Indian portfolios. the perception of it being so low risk is actually not mathematically substantiated. And investors only look at last 1 year return, 2 year return, which of course, as we speak today, has been stupendous in spite of the last week fall we have seen in the gold prices from its peak levels. So having said which, anybody who invests in gold never invests 40-50% of his or her money. So it's not about whether you made money. How much did you make in rupee terms has generally been low in most portfolios.
You know, just like as an advisor, you've learned from your mistakes. I must admit that as an investor, I too have learned from my mistakes. And one of the things that, I now choose to sort of employ is that if my advisor tells me, this is the way to go forward, I don't question it unnecessarily, because once I have selected an advisor, I have decided that I must trust them completely. But do you still have clients who doubt what you say, or rather don't implement what you say? How do you deal with it, and how does it turn out?
Yes, you will always have clients who would be suspicious, because they will be once bitten, twice shy. By having gone wrong with bad advice, product sellers giving them wrong products and not being worried about how it fits in their portfolios. So point one, yes, you have people like this who are your investors. But thankfully, anybody who spends 2-3 years in the relationship with an advisor graduates to be a person who does not do backseat driving. It will be very worrying if a 10-year relationship of an advisor and a client still creates suspicion on pieces of advice being given. That's a very big wake-up call. But fortunately at AnandRathi, we see some degree of backseat driving by the investor in the first 1 or 2 years, where he is also evaluating different interactions, different pieces of advice, and is wanting to see whether there are any biases which are commission related. Once that is put to rest, then you have a very smooth equation between the advisor as a wealth management firm and the relationship from an investor standpoint becomes a far smoother, well-oiled machinery over periods of time.
But Feroze, tell us, are there instances where you've asked investors to do something and they haven't done it?
Yes, of course. And then what happens is, then you don't give up. You give them more data to reason out why you would bring that advice to the table in the first place. Okay. Unfortunately, yes, we have had several such instances, but we maneuver through by not talking a lot of English, but backing that advice with a lot of data to make the person realize it's only in his or her interest would this be coming to their table for consideration.
All right, Feroze, thanks very much for joining in, and once again for advising and educating all of our viewers. With that, we've come to the end of this episode of The Investing Edge. Thanks very much for watching, but do stay tuned in, because here's some very interesting mutual fund analysis that's coming your way from Prathama Dhawan, who's the director and unit head at AnandRathi Private Wealth Management.
Thank you, Sumera. I'm here to evaluate SBI Blue Chip Fund, which is an open-ended equity scheme. As per AnandRathi's recommendation and selection methodology, we give it a score of 2 on 5 with a recommendation to sell. SBI Blue Chip Fund is an open-ended large cap fund, which by SEBI categorization means it needs at least 80% of its investments in large cap companies. The fund was launched in February of 2006. And currently, as on July 31st, holds an AUM close to 22,000 crores. The fund is managed by Sohini Adnani, who has 23 years of industry experience, and the investment style of the fund is growth strategy, which means that they aim to invest in large cap companies which tend to outperform the markets because of their future potential. Now, the fund is a well-diversified fund with 55 stocks across 10 and 11 sectors. 96.5% of the investments already done in equity, 3.5% in cash. 85% of its investments are in large cap companies, while the remaining 15% are in mid and small cap. Now, at AnandRathi, while we evaluate mutual funds, we use historical and futuristic parameters while evaluating funds. We use parameters like return consistency, risk, valuations, stock picking capabilities of fund managers, and return potential. On evaluation, what we found is that the fund scores below its peer group on account of risk, return, valuations. while it scores high on stock picking capabilities of the fund manager, which is denoted by the higher stray ratios. On a performance front, which is measured through rolling returns, the fund has again underperformed its peer group. It has delivered a 0.01% in a 3-year period, while the category average was 1.24%, and Nifty for the same period gave a return of 2.49%. Just to give you a perspective, what this means is that 1 lakh invested 3 years back would end up at a 1,08,000 fund value, while for the same period, if you would have invested in Nifty 50, the fund value would have been 1,15,000. On the risk parameter, which is measured through standard deviation, the fund again has a significantly higher standard deviation than its peer group. The 3-year standard deviation of the fund stands at 20.72, which is higher than the category average of 19.81, and Nifty for the same period had a 3-year standard deviation of 21.25. On the valuation front, the fund again scores low, being more costlier than its peer group. This is denoted by the higher PE and PEG ratios of the stocks that it holds. The standard deviation of the alpha generation also is significantly higher than its peer group at 4.76. So just to summarize, on underperformance on risk return and valuation parameters, it's a 2 on 5 score for us with a recommendation to sell. Thank you.